Hi guys, and welcome back to Series 3 of the Trading Intraday course. In this series, we're going to be going over liquidity inducement. Now, there's only going to be one episode in liquidity inducements because it only takes one episode. So without further ado, I'm just going to go straight into it. Now, before we get into the actual chart work itself, it's best to explain what liquidity inducements are for those of you who don't know. Essentially, liquidity and inducements are two separate things, but they're very, very similar. So the first one is liquidity, right? Liquidity in of itself simply just means money, right? Liquidity is just another word for money. So how does that relate to us? Well, ask yourself the question, where is the money? The money is in people's stop losses. Okay. So if that's where the money is, then where are people's stop losses? That is what we refer to as liquidity. And the different types of stop losses I personally know of and I consider liquidity. There is the first one, which is the double bottom, which is price creates a double bottom, expecting price to come back to continue forward, and instead it just hits the stop losses of the buyers, right? Because the buyers are expecting price to come into somewhere around here. They probably got the stop losses down here, and then price tags them out. So that's liquidity number one. It's the double bottom. And on the other end of that, you have the inducement theorem of the double bottom. The inducement theorem is those traders who trade the breakout. So that is number two, the breakout traders. The breakout traders are the traders that look at this and they say, okay, right, that is a double bottom. When that breaks, I am going to sell. Why? Because the support has been destroyed. Essentially, price is going to go lower. And they have sell stops here, right? And so they get tagged into their sell stops with their stop losses just below here. And then as smart money traders, we know, okay, now we've had a break of structure. We're coming to mitigate some level of supply and continue. And in the process, what do? We take out the stop losses of the sell stops. So we've taken out the stop losses of the buyers and the sellers, and then we get involved. So number three is essentially the exact same thing, but instead of double bottom, we're going to be referring to this as a double top. Right? It's the double top liquidity, which is the exact same essentially as the double bottom, just in reverse. So we have our stop losses just above here, they get tagged. Then we have the buy stops with the stop loss down here that get tagged. Then we have our demand levels from the break of structure, and then we're in and out, and the liquidity has been taken. So there's two examples using double tops and double bottoms on the liquidity and the inducement. The inducement essentially is the aspect of where people are to place their orders. So if liquidity is stop losses, inducement is orders, right? When you induce someone into a trade, you create a double top and you push price away. So now you've induced people into selling from levels like this, and then you liquidate them, right? And then you induce them again, which sends us on to our third piece of liquidity, which is the trend line. Here is a trend line, and then let's say let's do it a little bit differently so you can understand it from a logical perspective of how they form and stuff like that. So price has a push up, push down, push up, push down, push up, push down, push up. So price has a push up, push down, push up, push down, push up. Okay, so now we're forming a trend line, right? Price is beginning to trend in a given direction. below here, we know we have what? Liquidity. Because traders, when price comes back to here, they want to get involved. We know that their stop losses are below. Let's say we have levels of demand right here. We look at this as a liquid low because it failed to take out the high. That's how we look at the price. And what happens? Price comes into our level of demand, takes out the stop losses, but what else does it do? It takes out the stop losses and also the sell stops, because don't forget, everywhere there's stop losses, usually there are sell stops, right? So if the stop losses consist in here, then the sell stops probably also consist in here. So when we tag the sell stops, their stop losses are just here, right? So we take out the stop losses and tag in the sellers to then essentially take out the sellers as well. And the same is exactly true for a downward trend line. Right? Exactly the same. Exactly the same thing. Let's say, let's do like this. Let's say there's levels of supply. And here, this is a liquid region. So when price comes into here, it takes out the stop losses of those who are trying to sell on this trend line. And then it also tags in buyers who want to continue because they think prices broke out, because it's broke this or whatever. And it induces them, and essentially with the continuation takes them out. And so this is why a lot of retail traders get frustrated, right? Because there are times where retail traders are on the correct side of the market. It's just that they got in at the wrong area and they got tagged out and then price went with them. Because essentially structure is structure and order flow is order flow. And if any trader reads structure and order flow and builds a solid trading plan within those concepts, you will have some success. And so the retail traders that are pairing these double bottoms, support, resistance, trend lines, Fibonacci's with order flow and structure, there will be times where they are getting in at the right place, and there will be times where they're understanding where the market is going. But unfortunately, price just takes them out before it can get there, right? Or what a lot of traders do is they try to be extra safe, right? So let's say there's a double bottom here, and you're a retail trader, and you want to long, but you're scared of your stop loss getting hit, so you make your stop loss just way bigger, and you want to target up here. Now you're a 1 to 0.9, right? And then price might do this. And then this. And all of a sudden you stayed in. Some others that wanted a lower risk to reward, a higher risk to reward, got stopped out, but you stayed in. But you made a 1 to 0.9, which just doesn't make any sense, because on the next one, if you lose the next one, then what? So that is essentially liquidity explained and inducements explained in a theoretical perspective, showing you lines on the chart. Let's get into some actual price action where this becomes relevant. All right. There was one more that we didn't go through also, actually, which is areas of support, right? Or resistance. You have your resistance. Price doesn't want to break this level. It's come to it once, twice, 3 times. Or you have your support. It's come to it once, twice, 3 times. Now I'm going to buy. And all of a sudden, you just get swept out for liquidity. Okay, now I'm going to sell. And then get swept out again. Okay, I'm tagged in. Right? And this happens a lot of times. When you see a range, the purpose of a range is to build liquidity on both sides of the market, because the banks really want to initiate price in one direction. So by building a lot of liquidity at one time, then taking it with an event like NFP or with a news event, which happens all the time, then you will, that's essentially what you'll see, right? It's that, the range and then take of liquidity. So I'm going to show you an example right now of retail versus smart money, essentially, and retail being liquidity, right? And how to understand liquidity from a smart money perspective. So in here, if you haven't already seen, you will know that we have one piece of liquidity in the form of this bearish trend line. Oh, that is liquidity. We have probably more liquidity in the form of those traders that are trading the breakouts, right? Those triangle patterns where price comes in, goes out, and then they'll sell, and it'll probably just end up coming up. There's two areas of liquidity. There is a double bottom right here. 3 areas of liquidity, and then this overall level can be seen as a level of support, right? 4 levels of liquidity. So there are 4 different types of liquid levels in this area, right? And now let's see what a smart money trader would see, i.e. me and yourself. We would see that price has been pretty bearish, but it has had a shift of strength, shift in momentum, it's had a change of character, also a break of structure. We know that our demand range overall is in here. That has been mitigated once, I mean, if you actually want to go ahead and refine that range to the unmitigated level, continuing. Why not just the candle? Because it's the overall range, the accumulation range. If we go to a lower time frame, there'll be some levels of liquidity that this blue candle right here took out. So understanding that there might still be positions underneath this level of demand isn't wrong. It's positioned really well in a underneath lots of levels of liquidity. We have what? Very nice liquidity to target. All of this is liquid. Another thing that I didn't actually mention is built up mitigations, right? So from a smart money perspective, we understand supply and demand. So if you have a leg of price like this one, where all of the levels just seem to have been mitigated, like mitigated, and mitigated, right? It's just a continuous mitigated supply chain. That means that these areas are going to be easily ran, right? Because there are no resting orders in here. So we will probably see no resistance when we approach those levels. So that's another form of liquidity, built up mitigations. So we have our retail traders positioned. We have buyers and sellers at the ready when this gets broken, sellers when this gets broken, buyers when this gets broken, sellers when we tap into here. So retail are locked and loaded. And us as smart money, we just understand very simply, we've had a change of character to the upside. We have lots of liquidity. We have a point of interest that changed character. And if we shift order flow on the lower time frame, then this high becomes weak. We have lots of liquid regions that we can essentially head into. And so there could be a very nice 1 to 9 setup here. This isn't exactly our strategy. We'll go into that in the next episode, just making this for example purposes. Let's see how price plays out, right? What is that? That is exactly the bank manipulating price to do exactly what it needed to do. It's taken out stop losses right here, more stop losses from the support traders. It's tagged in sellers from this breakout. It's taken the stop losses. It's tagged the sellers in from this breakout, from this breakout, from this breakout, or the trend line that's forming here. It's taken the stop losses. Now it's taken the stop losses from the buyers and probably induced more buyers also. In one candle. In the second candle, we'll run to the take profit. And for those who brought when we broke out, they brought when we broke out, wherever it is that they broke out, wherever their stop losses are. I'm not exactly sure. But you can see that price then does what? Sells off completely, taking out all the remaining stop losses. Because let's be real, right? The banks essentially wanted to take price to the downside because order flow is bearish. How do you free up all the positions in the market to be able to do it so aggressively? Build up all of this liquidity, all of this liquidity, all of this liquidity, and all of this liquidity. And that is exactly how you trade with the banks and how to understand liquidity concepts. So guys, in the next episode, we're going to be putting everything together and giving you trade breakdowns from top to bottom. And then we will be finished. I hope you guys enjoyed, and I'll see you in the next one.